Most people think that if a global war started tomorrow, their first instinct would be to call family, check on friends, or look for safety. In reality, many people would do something far less heroic. They would open their brokerage app, not to help anyone, not to understand the situation, just to stare at their portfolio. Because that's what financial anxiety does. It hijacks your instincts and points them toward a number on a screen, as if your portfolio personally needs you to save it from a geopolitical crisis. And here's the strange part. While some people panic sell their index funds at 6 in the morning, convinced they're being responsible, someone else is doing something that looks completely irrational. They're buying. Not randomly, not recklessly, but in a very deliberate order based on how money has historically behaved during every major war the United States has experienced. My name is James, and what I'm about to explain will probably feel wrong while you hear it. That's because the relationship between war and financial markets is one of the most counterintuitive stories in investing. If you don't understand it before the next crisis, it could cost you a lot of money. Before talking about investments, we need to talk about the people who benefit most when you make the wrong decision. It's not foreign governments. It's not hedge funds. It's the financial media. Not as a conspiracy, but as a business model. Whenever geopolitical tension rises, viewership rises, engagement increases, advertising revenue increases. Fear keeps people watching, and the longer you watch, the more profitable that fear becomes. So when markets drop 2% and a headline screams global markets in free fall, understand what's happening. A 2% drop is ordinary. It happens all the time. But ordinary pullback doesn't attract clicks. Free fall does. Financial media doesn't just report fear, it amplifies urgency around it. They bring in the most dramatic expert they can find, give them airtime to predict chaos, and then cut to a commercial advertising a brokerage platform perfectly happy to process your panic trades. The entire system quietly benefits when you react emotionally. Let me introduce two people, Mark and Sarah. Mark has around $40,000 invested in index funds, stable job, decent financial habits, but he watches a lot of financial news. When Russia invaded Ukraine in February 2022, Mark spent hours glued to the coverage. Every segment used words like crisis, shock, and uncertainty. By 9 a.m., he sold everything. Sarah woke up to the same alerts, same news, but she saw one statistic. Since World War II, the S&P 500 has recovered from every major conflict within an average of roughly 47 trading days. So she turned off the TV and went to work. This video is essentially the story of what happened to their money afterward. And the difference between them is frustrating. Here's the data point you rarely hear first on television. Markets rarely collapse permanently because of wars. They drop briefly. Then they recover. During World War II, the Dow gained around 50%. During the Korean War, about 60%. During Vietnam, roughly 27%. Since 1945, the S&P 500 has produced positive one-year returns after the majority of armed conflicts. At this point, the market has survived 2 world wars, a nuclear standoff, multiple recessions, pandemics, political chaos, and more. It's basically a cockroach wearing a business suit, and the suit keeps surviving. The reason is simple. Wars are massive economic stimulus programs. Governments spend enormous amounts of money, weapons, logistics, fuel, communication systems, infrastructure, and technology. That spending flows directly into companies. Those companies report higher revenue and earnings. The investors who historically suffered the most weren't those who stayed invested. They were the ones who ran to cash. Here's what happened to Mark. On the morning of February 24, 2022, he sold his $40,000 portfolio after the market dropped about 2.5%. Later that same day, the market closed higher. He missed the recovery and stayed in cash for months. Cash that slowly lost purchasing power due to inflation. Meanwhile, Sarah did almost nothing. She kept her automatic investments running, but she also added a few strategic positions. Before explaining those, we need to understand something important. about panic selling. From the inside, panic doesn't feel like panic. It feels like clarity. When the market is falling and headlines are frightening, selling feels logical. You feel relieved after pressing the button because you've done something. But then the recovery begins, sometimes quickly, and you're stuck on the sidelines wondering when it's safe to return. Usually the answer your brain gives is not yet. JP Morgan studied this exact behavior. A $10,000 investment in the S&P 500 from 2005 to 2024 grew to about $71,000 if left untouched. Miss just the 10 best trading days in that entire period, and the ending value drops to around $32,000. 10 days out of thousands. 7 of those best days usually occur within 2 weeks of the worst days. In other words, the crash and the rebound are almost the same event. The news covers the crash intensely. The recovery barely gets attention. With that context, here's what Sarah actually did. Step 1. Build a cash foundation. Before investing further, she kept about 6 months of expenses in safe, liquid savings, part of it in a high-yield savings account or money market fund, and a small amount of physical cash at home. That last part sounds extreme until you remember that modern conflicts increasingly involve cyber warfare targeting financial infrastructure. A few weeks of physical cash is simply a temporary safety net. But the key point is, stop there. Holding excessive cash during wartime is historically a bad strategy because wars tend to create inflation. Money sitting idle loses value while real assets rise. Step 2. Gold. About 10 to 15% of her investable assets. Gold does often rise during periods of uncertainty, but timing matters. In many crises, gold spikes early because of fear and then falls once the worst scenarios don't occur. Today, however, demand has been driven partly by central banks buying large amounts of gold to diversify reserves. That kind of structural demand can support prices. Sarah held gold through a low-cost ETF and kept a small portion in physical coins as a backup. Step 3. Defense companies. This trade appears again and again in wartime history. Defense contractors receive enormous government contracts during periods of conflict. After 9/11, major defense stocks surged rapidly. Over the long run, many of them delivered massive returns as military spending expanded. Instead of choosing individual companies, Sarah bought a diversified defense ETF that spreads exposure across the industry. Step 4. Energy. Conflicts often disrupt oil supply chains or threaten key shipping routes. When supply tightens and uncertainty rises, energy prices can surge. Energy companies then generate extraordinary profits. In 2022, while the overall market struggled, the energy sector dramatically outperformed. Step 5. Consumer staples. During difficult economic periods, people cut discretionary spending, but they still buy household essentials: soap, medicine, groceries, cleaning products, beverages. Companies selling these products tend to be far more stable than cyclical industries. Staple stocks don't usually excite investors, but they provide stability when markets are volatile. Step 6. Inflation protection. Wars tend to involve large government borrowing and spending, which historically fuels inflation. Traditional long-term government bonds can lose real value in that environment. Instead, Sarah added inflation-protected securities that automatically adjust their value as inflation rises. And one thing she absolutely did not sell: her index funds. Broad market exposure has historically performed surprisingly well during wartime economies because government spending stimulates corporate earnings, so she kept contributing regularly and ignored short-term noise. Now let's return to Mark and Sarah. Mark sold his $40,000 investment during the panic. He stayed in cash for months and eventually re-entered the market after prices had recovered. He missed the biggest gains in energy and defense. He also triggered taxes by selling his original position. 4 years later, his portfolio is worth roughly $48,000. Sarah started at the same $40,000, but she kept investing monthly and added the positions we discussed. Today, her portfolio sits around $91,000. Same starting point, Same news headlines, but a $43,000 difference. Sarah didn't discover a magical stock. She simply stayed invested and used fear as an opportunity to buy quality assets at lower prices. Mark reacted emotionally and paid the price. Imagine the next crisis. Your phone fills with alerts, headlines turn red, analysts explain why this time is different. One person panics, sells everything, and watches the recovery from the sidelines. Another checks their plan, confirms their portfolio structure, puts the phone down, and continues their day. One person builds wealth. The other unintentionally funds the system that thrives on their fear. The time to become the second person isn't when the crisis starts. It's right now.